Good afternoon, everyone. This is Matt Rupert, one of the advisors with your Palomar Wealth team. It's the afternoon of September 23rd, and once again, unfortunately, we've had a week of negative market returns. We wanted to reach out today, just as we did earlier in the year, as we've been going through quite a bit of volatility and negative returns in the market. As we've had concerns from client on what's what should they be doing, what's the best approach to take, and our biggest concern is that people may be thinking about, do I just cash out on the market and step aside? And we really recommend that you not do that. Timing the market is notoriously difficult to do. And so one of our mantras is it's more about time in the market than it is timing the market. As you know, our strategies are based on data analysis, and we like to not try to predict what might happen next because it's not a guarantee. And so we wanted you to hear our voices today to hopefully provide some comfort and some thoughts as you experience this. We understand that it's not great to be going through these times, but want to provide some assurance that we are here to help you as best as we can. And so to help with that, I wanted to share some visual documents to talk about why it's important to stick with a plan and not overreact in these situations. So let's take a look at these two documents. This first document here is talking about market volatility, and the next slide will be very, very telling on why we encourage you to not react too rashly with your investment decisions. You can see here that this graph is going all the way back to 1950 through the end of prior year, and these periods of green and red are representing different bull and bear markets throughout the past. Now, we understand, the past is not a guarantee for what's going to happen in the future, but we are a data-driven practice, and I think it's still helpful to look at data from the past to shape our decision making and how we approach investing. Historically, bull markets have been longer than bear markets, and the positive growth in those bull markets has been higher in absolute terms than the negative return on those bear markets. This next slide, or the next page, sorry, is what I would like you to focus on as one of the biggest takeaways here of this conversation is, if we look back from the beginning of 2007 through the end of 2021 and think about, if you were an investor, what would your return have been with an investment similar to the S&P 500 if you had stayed invested that entire time period? And keep in mind that that time period covers the Great Recession of 08 and 09, which had substantial downturn. And I'm sure you'd be in that similar feeling like some of you are now of, hey, is this the time that I just, not really participate in the market? But as you can see, this graphical representation, that if you stayed invested that entire 15 years, that resulted in over 12% annualized return. And it took only missing 10 of the best performing days over that 15-year period to drop that 12% return down to about 4.25%. Bump that up to 25 days missed of the best performance, and that performance has now gone negative. And I hope that this sends a powerful message that making a decision like going to cash or getting out of the market could significantly impact your long-term outcome and what you're going for your investment portfolio. And that's why we do not advise you to try to time the market and go to cash. This is a very substantial impact to your overall success to a long-term plan. The other piece I wanted to show is the market volatility and how the markets have reacted after market lows. So on this chart, you can see some of these significant market downturns in the past. I just wanted to, for example, highlight the first one here is March of 2020, and that is right as the COVID lockdowns had taken hold in the US and globally. March 23rd was the bottom of the market decline at over 33%. But as we know, if you look back at how 2020 went in total, is the market actually recouped those losses and then had gain on top of that. And amazingly, the first 3 months after that low point of March 23rd, there was a 40% return in the S&P 500. So again, looking at data and historically, there is no guarantee that, okay, we're at negative 20%, negative 30, it's going to keep going. I need to get out. It could go either direction. And we have many cases here where fairly shortly after those low points in the market, there has been large recoveries coming back the other direction. So I think that ties in nicely to the previous document where we're talking about how few days it could take to greatly impact what could happen to your portfolio. So again, wanted to share this information with you. Make sure that you are hearing from us. We are keeping our clients' top interest in mind. For those of you that have your investments in our data analytics models, you should know that every week, every month, we are getting data, and we have reacted to that data already this year in terms of how we have traded between equities and fixed income in trying to react as best we can to what we're seeing in the market and economic data. And we're going to continue to do that. And so please, if you have further concerns and you would like to hear more from us, we invite you to email and call us. And we are, of course, happy to reach out to you and have those conversations. Thank you.